Welcome back to another episode of Multifamily AP 360. And today's our guest is Kim Bruggeman. Welcome, Kim.
Hey, happy to be here.
Yeah, thank you very much, Kim. And little bit about Kim. With over 25 years of experience transforming underperforming assets into thriving, value-driven communities, Kim brings a rare blend of operational expertise, investment strategy, and purpose-driven leadership to every conversation. As the founder of Lighthouse, Kim has led turnarounds across multifamily, affordable senior and student housing nationwide, empowering investors to create profit with purpose. Her insights on optimizing performance, strengthening asset management, and building intentional communities equip audiences with affordable tools to maximize returns while making a lasting impact. Kim's passion for building quality investments and communities on purpose for purpose, inspires investors and operators alike to elevate both their portfolios and their people. So, with that, Kim, you want to add anything to your background?
No, that was amazing. I appreciate that awesome introduction.
Thank you very much. After 25 years of turning around underperforming assets, what are the first three operational levers you pull immediately after acquisition? And why do most owners miss them?
Can you repeat that? The operational levels you said? I'm sorry.
First three operational levers you pull immediately after acquisition. And why do most owners miss them?
That's a great question. And I think it actually starts pre-acquisition for me. A lot of what I talk about in asset management really starts prior to the prior to the acquisition itself. And it's in that underwriting phase. And once you work with your your underwriter on that pro forma, it's about creating, for me, the actual operations plans, the financial plan, and the CapEx plan that are physical written plans that we can execute. I think a lot of operators or general partner groups miss that. They do the underwriting and then they get to closing and they hand that underwriting over to the operator, to the property management company. And as the asset manager, I think it's critical to have those plans that are going to be able to support that underwriting effectively, already designed to hand over to our property management company to execute those. And then being able to have the metrics that we can monitor the financial plan, the operational plan, the CapEx plan from day one. So being able to meet with that property management team upon closing and really make sure that we are kickstarting that transition in a very healthy, strong manner to be able to monitor those goals within each of those plans.
Got it. Thank you. And you have rescued distressed properties across multiple housing sectors. What's the most common root cause of failure in struggling multifamily deals today?
I think I'm going to have to go back to my original response is not having those plans. I think a lot of people do their underwriting on a template and really not understanding and working with your team, working with an asset manager and your property management team to make sure that is something that can be executed. They underwrite it with these numbers in mind and they work with their market study, but they're not really looking at how that can be successfully executed. And I think they're also not having an experienced asset manager on their team that is overseeing the property management team throughout the operational cycle. And it's causing failure because things start to shift that they're not monitoring. They've turned it over to the property management company and they're hoping for success, but they're not really understanding what KPIs to monitor and seeing where other things behind the KPIs are drifting. So they start to have a drift in one area and the rents aren't achieving what they hoped that they would see, and they're starting to pivot in one area, or risk and liability issues, unforeseen plumbing came up, and they're making changes in the CapEx plan that are affecting the operational plan and the financial plan, but they're not updating those plans. And so they're starting to see a pivot and they don't really understand how to make that pivot or when to make that pivot. And so things start to really landslide down, and then they're not communicating with each other to be able to have a strong support and communication in between the different plans to make sure that when we make a decision in one, we update that other plan to make sure that it can be successful as well.
Got it. Got it. Thank you. So from an asset management perspective, where do most business plan fall apart between underwriting and execution?
I would have to say unrealistic expectations, trying to make the plan work for the number instead of understanding that the story may take some time, that it's a journey that has to be communicated. I think the underwriting, again, as I've mentioned, is people often mistake it for just putting in numbers and not realizing it's a budget that you've created that tells a story that has to have a plan to support it. And again, it's executing that plan, but it is so critical to have reporting and metrics and communication with your operations team to make sure that they are executing not only your numbers, but your vision and your culture and your values on your property. Are they building communities on purpose? Are they understanding what your residents are looking for? Looking at your risk and liability issues, things that are going to make you lose your money? Are they looking at preventative maintenance, things that are going to help you make your money or save your money? They're looking for preventative maintenance. I'm sorry, let me rephrase that. It's risk and liability, things that are going to make you lose your money, preventative maintenance, things that are going to help you save your money, product improvement, things that are going to help you make your money, and then retention, things that will help you keep your money. I think people jump right to product improvement because they think, oh, if I renovate these units, I'm going to make more money. And they're not looking at that plan that identifies all your risk and liability issues. And that's in your residents, that's in your people, that's in your employees, that's also in your management team, your market. You're identifying those risk and liability issues there. Then it moves into your preventative maintenance. You're working with your employees to make sure that they are handling your residents and their risk and liability issues. You're working in your market to maybe handle reputation repositioning. So they're not just looking at the product itself, it's about looking at your people, your product, and your market in each one of those plans. And then knowing how to, I often say, about juggling your balls all at the same time and making sure that you're not just focused on one ball as you're moving, that you're focused on many, and you're knowing how to reintroduce a ball at the same time that you keep moving. So when you have a risk or liability issue that comes in, you're able to, like I mentioned, update your CapEx plan that might need to pivot to add for a $20,000 plumbing issue that happened on the property. So I think that's a big key to understand is looking at all of those things from the underwriting to the execution, and then making sure that your property management team is executing that the same, to support that, and then knowing how and when to pivot.
Okay, there are a couple of follow-up questions. Based on your experience, what are some unrealistic assumptions in underwriting that you observed based on your experience? And second one is, would you elaborate on risks and liabilities point of view?
So that's a great question. The risk and liability issues that I often see, as I mentioned, when I'm writing a business plan or operation plan, it includes risk and liability issue, it includes the areas of people, our market, and then also our product. So in the people side, the risk and liability issues could be employees that are, you may have kept an employee that was previously on the property to have some continuity of historical on the property, and it's knowing what are the issues that maybe that employee could have contributed to other issues on the property at all, but you may keep them for a short period of time for the transition. Or it may be a great employee that just possibly needs some more training. So you're looking at your training manual in areas that you might want to help them in leasing, in building community, giving them processes that maybe they just lacked. So you're looking for that, or do you have metrics that your property management company has in place to watch for theft? There's a lot of areas that an employee can steal on the property. And I've being a receiver and an auditor for so long, I've had to come in and audit properties in the financial side of it, but also the operational side. So I've probably seen every area where somebody can steal. That is, I think I can review a P&L and operational reports, and I've designed a lot of them to show me those back doors where I'm seeing a lot of that theft happening. So that's in our people, but it's also in our management company, the people within our management company. Does your management company have the right team that is executing your plan? Are they training those employees that are your employees on site? Are they aligned in vision and in culture and experience to be able to execute that plan? And do you have a good regional manager that is reviewing the operations and the financials before you're getting them? As an asset manager, one of the most frustrating things for me is to get a P&L that nobody has looked at prior to me. They send me over the financials and it's a click and send at the end of each month. And nobody has looked at that and really given you a story that supports any variances. They'll give you a budget to actual and that's it. But nobody's saying we had this or we're starting to see this trend here. So it's making sure that the people that you've hired are looking at those and they are executing your plan as well. And then it's in the marketplace, the risk and liabilities within our market. We're constantly looking at what's coming and what's going. Are we having one of your first question was one of the things that I see are unrealistic expectations. And a lot of people will underwrite growth immediately within that first year on rental rates. And depending on the market that that you're in, or the investment itself, especially on a lot of B and C class assets where your value add is repositioning the asset, both in the product and in the marketplace, and adding your value add in rents, they're not looking at the fact that the occupancy and the rents may dip before they become higher, because we have to, part of those people are looking at our resident base. And prior to our closing, in our due diligence, did we look at the rental criteria that was in place? Did we look at the qualifications of our current residents? So that property may be stable at 95 plus occupancy, but it's full of people that the seller may have just put in there, or they may have had a different rental criteria. They may have sex offenders, they may have violent crime people in there that you don't necessarily have. And so when you enforce your rental criteria in there and you renew that lease, it has to follow your rental criteria. So you may have 25% of your people non-renew, and have we factored in for that? And then looking at the fact that we can't just add $100 to our rental growth. We have to look at truly developing a leasing plan that is unit specific year one and then year two. And then, as I mentioned before, really making sure that you're monitoring that. Did we see growth in that we weren't able to see, that we can start to push that a little bit more? I think a lot of management companies just give the renewals to the management company and they're incentivized on the growth of that. So they're not really looking at the risk that they may be putting in a bad tenant or renewing a tenant that we want to get rid of. So I think, as I've talked about, having that operational plan includes this leasing plan that is going to be very specific on every resident. And I know a lot of people often they're like, oh, that's too detailed, Kim. And I'm like, no, this is your business plan. This is what you're paying your property management team to do, is to really identify that. And on our properties, I don't do leasing bonuses. We do KPIs at the end of each year for overall performance, because I feel like it is our management company's responsibility to lease, and that property manager's job is to lease. And so if I'm incentivizing them to lease and to do a renewal or to do a move-in, then they may feel like they have to put everybody in there to get that number, without feeling confident that we may have to, like I said, dip down to be able to get a higher, more qualified resident base to be sustainable. So I think an unrealistic expectation is going for rent growth and occupancy growth without having the data and the plan to support that, and being confident to yourself and to your investors that you may have that year one. I don't project any rent growth year one. I always give myself a very conservative runway year one to be able to handle the what ifs. But again, that's if I've come into a property where it's already underwritten and having to execute it as an asset manager. But I think the key is having your asset manager. If you and I are going to buy a property, I want to be a part of that in the very beginning so that we can have that operational plan matching that financial plan from day one.
Got it. Thank you very much. Thank you for elaborating that. So what kind of data required for rent growth or financial growth assumptions?
I'm not sure I understand that question. What is to
You mentioned data need to support for rent projections or rent growth or whatever projections, right? So what kind of data you look, you know?
So when I'm looking for projecting, I should say when I'm creating my operational plan,
Yeah.
then I'm looking at your pro forma. Your pro forma has already taken into account the seller's numbers, right? You've looked at your historical income and your expenses. And then you're underwriting that based upon what you believe. You've also done a market study, hopefully, and you're looking at your competition and you're seeing what their rents are that they are achieving. And then you're underwriting that to see where your growth can happen. I think that the metrics that I look at are truly in the marketplace where I look at your comps both in location and in your like comps. So you may have A-class assets that are next door to you or down the road, and you're not including those in your market comp. And that is one of the big mistakes I see in data management for your market comps, because your A-class assets are different than B and C, or syndications where people come in and they're purchasing a property to hold it, say anywhere from a 3 to 7 year hold. An A-class asset is usually something that's a much longer term. It could be a new build, something that has a longer debt margin in there. So they have the ability, and especially that we've seen in the last 5 years, where these A-class assets can lower their rents to be able to get their occupancy higher and sustainable when the market dips at all. And then they're at your margins now for rent, and they've become your competition. And of course, a C-class asset is going to really struggle to compete with that A-class asset. I've been a part of '08 and '09, and I've been a part of the last 5 years of seeing the market cycles drifting. And I think people don't account for that. They don't look at where their market is truly sustaining their rents, and they allow their management company. One of the other things that I think is contributing to the failure of a lot of these assets performing operationally is they have a property manager that they say they're doing a market study. So they're looking at it maybe once a year. Some will say they look at it monthly, some will say that they're looking at it quarterly, but it's really just to check the box. Nobody's really reviewing that and looking in your market. Like I mentioned, what's coming and what's going. We saw such a clear view of between COVID and interest rates and inflation, how it affected markets in general. So what is the market that your property is in, and is it sustaining growth or is it having issues? And so we're able to look to see, do we need to temperature check our rents before? Are our competition lowering their rents, or are they offering move-in specials? We're starting to see things like that are happening, or there deferred maintenance happening around us on other properties. So on our market surveys, I make our managers take pictures of the assets. I make them show me marketing material that they're having. So it gives me, I trust, but I verify that they're actually looking at those market studies, because that's going to sustain where my rents are. If you're in affordable housing, looking at your programs that are sustaining your rents. So a lot of right now you're seeing with the big beautiful bill right now that's being passed, it's affected a lot of funding for states. And it's good to the fact that it is flushing out groups that are not legitimate. The purpose of funding, and especially in the low income affordable market, is to not just provide a handout, but a hand up to help people become sustainable in life. So you're giving them rent, but you're also giving them wraparound supportive services that are going to help them sustain their living. But a lot of these programs have lost money and funding. And so is your property right now being supported by these programs that are no longer going to be funded? So I think that's also looking at who is your margin, who is, people that are coming in, and what are their rents and their margins for these rents to be? Are they lowering their support for their housing? So I think that's another big issue in the market. People on Section 8, and they're losing their percentage of funding, which is going to lower your support in rents. And I think one of the other things on that is having your rent roll be broken out by, if you do have a low income or affordable housing property that you're, or even any rents within your property that are that, breaking it out by subsidy rent, and then also the resident portion. A lot of management companies don't do that. So you're not able to see, are we losing subsidy support, which is going to put the pressure on the resident to pay more, and are they able to pay more? Because remember, we qualified them on their support, right? And then maybe halfway through or year two, the property manager renewed that resident without requalifying their support. And so these things are dominoing into year after year, which is then starting to see a drift in your income on these properties.
Awesome. Thank you very much. So what are the top KPIs you would track from performance point of view or from NOI point of view?
So I do, from an asset management perspective, I look at, we require our property management teams to use what I call a war report, which is our weekly activity report. And it's our dashboard of what's happening on the property. So I'm a little bit more old school, and having technology is great for automation, but I really want the involvement of our property management team, and also both the property management company and the involvement of the on-site property manager. So our weekly activity report is something that's designed to give me the data metrics of what you would normally see on a Monday morning report, a KPI, which is your move-ins, your move-outs, your income, your debt, or your delinquency, your number of work orders, number of rent-ready units. So it definitely has those KPIs weekly that I'm looking at, but it has a story section for each one of those. And it's designed to make sure that the property manager is communicating what's happening on the property. I often tell our property management team, it is your job. Your number one job is to communicate what's happening on this property, communicate with our residents, and communicate to us, the ownership team, or to the asset manager, or to your property management superiors. And they're the eyes on the property. Automation today has taken away a lot of the old school having to do rents and collect rents and things like that, but it's also taken away the face to face with the property manager and the residents. And if you're truly building a community, no matter what type of property that it's on, whether it's a low income property to a class asset, my job is to make sure that on-site manager is being interactive on that property. What are they doing? They do week over week. They have to identify your dashboard on leasing that's showing me we had this many move-ins, we had this many move-outs, but more so I'm looking at week over week, how many residents haven't paid? What is my economic occupancy week over week? Because at the end of the month, when most people look at their financials, it may be great, but you're starting to see that most residents aren't paying until the third week, or they're paying payment plans. So, you're watching a property, and it could go either way in monitoring this. In the beginning, when we take over a property, it may be high in occupancy, but the delinquency it's okay, it's stable. But what you don't realize until you buy it sometimes is that 50% of the people don't pay till week 3. Your mortgage is due by the 10th of the month. Your payroll is still due. I look at that each week so that I can see exactly how many, if I have 27 residents that haven't paid their rent by the second week, then we have a problem. Is it that they're accepting payment plans? And then that goes back into where I talk about that leasing plan, that we may not renew those people that are the no payers, obviously, but then we start to maybe non-renew the slow payers as the property starts to stabilize. I want to get rid of those so that we can start to collect our rent on time. But what I don't want to do is dip the occupancy the first year by getting rid of the slow payers at the same time. And then I haven't worked on, as we talked about, the product improvement, the reputation management of the property within the community. So it's really about looking at all of these things simultaneously. You're looking at your leasing plan also while you're looking at our CapEx plan, and we're working on our renovations and we're working on our exterior of the property, because it's really hard. You asked earlier about the unrealistic expectations. If we are repositioning that property as an owner in the marketplace, maybe for bad management that was there before, or deferred maintenance, or not having a product that could pass inspections and so forth. We're having to work on the risk and liability, is working on that reputation management in the marketplace. Remember, I talked about the programs. We have to be in there meeting with these programs or meeting with our places that we market to get residents. So we might have to reposition the product in the marketplace. But at the same time, we want to start putting things out in our property that show new management, building communities on purpose, like showing that you're different than what was there before, not just renovated units. What are you truly doing differently in there? And I think that is critical. And so this war report that I do, it shows each one of those. Remember, I talked about juggling all the balls at the same time. It's making sure that the management company and your operational team isn't focused on just what is generating revenue to them, which is the income, right? We want to be looking at what are we working on, the CapEx projects that we have in process right now, the work orders. I want them to tell me a summary of the work orders that are happening so that it shows me that the manager knows that our common work orders are pest control, plumbing. And then it allows me to see something and say, okay, maybe we need to change something up in here if I'm seeing a lot of continuity in that. Or are we looking at these plumbing work orders? I'm seeing a lot within a certain building that we might need to jet out that building. It's not just looking at a number of a KPI. I think it's really identifying the position of the asset and looking at that weekly. And then by the end of the month, you're able to have a report that shows you the activity of the month of that property that will support your P&L, so that you're not just getting a financial and saying, wow, what was this difference here? And why was this? Or things start to drift that you're not really aware of. If you're starting to see a lot of traffic, but you're not really seeing the closure on the applications to showings, then I want the manager to show me in writing that it's because we don't have a washer and dryer in the unit, or we don't have a playground, and most of the people that are coming here are children or have children. It's things like that give us the opportunity to decide, maybe we didn't realize that. So maybe we should budget to put a small playground in on the property, or maybe we should vamp up our washer and dryer facility, our laundry room, or can we offer, what would be the cost to retrofit a unit with a washer and dryer? So you're able to start to see these things. And then most importantly, it shows the communication from your property manager to your management team, to your asset manager, to your general partner group. And then it also gives the confidence to your investors and your team that you are looking at those things. And as you're growing your portfolio and you're buying new assets, because a lot of general partners I see, if you ask me, in one of my top 10 things that are failing is people get in acquisition mode and they purchase a property and they turn around and they start to work on a new property and raising the money for another property. And nobody is looking at the oversight. They think they've hired a good property management company and they've turned it over to them, but they're not monitoring where those things are starting to shift. And then they're not knowing that we need to pivot, and then they're not communicating to their investors if there's an event that has occurred that we might need to shift in some capacity. They communicate to their investors when they can't pay them, and that's about it. So hopefully that answers your question.
Yeah, awesome. Thank you. Thank you for elaboration. For operators managing asset through today's volatility, what mindset or discipline matters more than market timing or deal structure?
I think it goes back to paying attention to the details. The mindset has to be ability to pivot. And one of the most critical things that I would share with somebody is not being so structured. A lot of GP groups feel the pressure that they underwrote this property and they communicated this business plan to their investors and to their lenders. And they are afraid to go back to the lender or to the investor and say that the asset is underperforming or there's been a variance from my pro forma. And when we go back to that point of having that pro forma, that pro forma is your budget. It has to be fluid. It has to be something that this is your best case scenario of what you're hoping your investment cycle is going to perform at. But what's critical is having these metrics where I talk about, for us, it's having that weekly report that turns into our month end, truly detailed summary of what's happening. You cannot, gone is the day of 5 years ago where you could operate an asset and it just because of the market, it would perform and it would make money. Now there's so many, as I talked about, between COVID started the cycle of delinquency and job loss and so forth with people. Then you had loans that had interest rate changes, people who went bridge debt who needed to go permanent and could not do that based upon their underwriting of a certain interest rate. You had inflation where they underwrote a CapEx plan that did not support the cost of labor changes or the cost of material or the timing of delivery, right? To be able to execute these renovations. Things started to shift in each one of those plans. As I mentioned before, your financial plan started to shift, your operational plan started to shift, and then your CapEx, right? So each one of them started to shift in a way that did not communicate to each other. So the mindset is being able to communicate and have the mindset that we're going to have to pivot and we're going to have to make changes. And so for me, it's updating that, taking that monthly report, and we update our investors quarterly. And so that is being able to look at your pro forma to actual and saying, okay, here's the variances to that each quarter. Am I starting to see a trend that needs to have a pivoting mindset, right? Knowing, as I mentioned earlier, when to pivot and how to pivot. And then most importantly, communicating that to your investors, maybe to your lender. And most people, they don't think the lender is paying attention. They're just sending the financials on. Their asset manager is paying attention to a shift in whether it's in your P&L or in your rent roll or your balance sheet, but it's also to your investors and letting them know it's okay that an event happened. I think one of the most critical things I'm seeing right now that is it's really scary is that there's so many general partner groups that have bought these properties that are having these variances to their pro forma for a multitude of reasons, and they're putting their head in the sand and they're not communicating, and they're afraid to go back to their investor and say, hey, this happened. And so you're seeing so many investor deferred returns right now. And I get calls all the time from investors to audit properties to understand why their investment is underperforming. And a lot of it is legitimized through the market itself or through, as I mentioned, legitimate reasons, but nobody communicated that to them. And a lot of what I do is coming in and helping a general partner group even make sense of that. They got so far away from understanding, maybe because they bought a new asset or they bought five at the same time, and they feel they've had those same things happen on all of them. So they don't know how to pivot, and their mindset is failure. Like, I have failed, what I promised to my investor, and now my reputation is going to be bad. Your investor invested with you because they believe in you and they trust in you and they want you to communicate to them. So as long as you're communicating and showing them, hey, we've had this, but now that mindset has to be, but here's how I've pivoted and what we're doing moving forward. I think a lot of people, they created this underwriting that has become written in stone. They gave it to their management company who created their budget to support that, but nobody is looking at that realistically and saying, hey guys, we need to change this, or we're not going to hit these rents. So we're going to have to pivot year two now. These numbers are going to change because we can't achieve that number. But the good part about that is we're not going to lower our occupancy, but we're not going to increase our rent. So we may not gain that income that we were looking for, but we were sustaining because we also had an event that we, like I mentioned, maybe a plumbing issue that was unforeseen. So I think that's key, that people need to be able to look universally at the operations and the financial plan to be able to communicate together, because the mindset is they either look through a straw and they're not looking at everything, or they've turned it over to the management company and they're hoping that is what's going to be sustainable.
Yeah, good information. Thank you very much. So how can listeners can connect with you, Kim?
Our website is lighthousemultifamilysolutions.com. So you can check us out on our website. You can email me directly. There's an info section on there. You can reach out to me directly. We've also started a Lighthouse, it's called our LAMP program, our Lighthouse Asset Management Mentorship Program, and our Bridging the Gap education to teach people on asset management. And everything that I've talked about today, our mentorship program is designed to help support asset managers today. And we're talking about mindset and helping them to what to look for if they've had events that are pivoting. It's to give them support during that time. And then we also have the education, which is going to give them specifics on what to look for in asset management. So I think you can reach out to us and work with us on any of those capacities. We also offer asset management as a third-party service and property management to our clients that we are working with as well.
Awesome. And thank you very much, Kim. Really appreciate it.
Thank you.